Dollar cost averaging versus timing the market. One of these strategies is used by some of the smartest investors on the planet. The other one is what most beginners try to do, and it's quietly one of the biggest reasons they lose. Let me break down both, show you which one actually wins, and prove it with my own real money portfolio. Welcome to Highwater. If you're new here, this channel runs one simple system: buy great companies when they're beaten down and on sale, a little at a time, and hold them for the long run. Real money out in the open. And today's topic, dollar cost averaging versus timing the market, sits at the very heart of how this whole method works. Let's start with timing the market because it's the one everybody instinctively tries first. The idea sounds perfect. Buy at the exact bottom, sell at the exact top, capture the whole move. Simple, right? Here's the problem: nobody can actually do it, not consistently. Not the professionals on Wall Street with teams of analysts and supercomputers. Not the guy on social media with the crystal ball thumbnail. And definitely not you or me. The market bottoms when you least expect it, usually on the scariest day when every headline says the world is ending. That's precisely the day almost nobody has the guts to buy. And the biggest up days in the market tend to cluster right next to the biggest down days. Miss just a handful of the best days over a couple of decades, and your returns get absolutely gutted. That's the dirty secret of market timing. To win at it, you have to be right twice. Once when you get out, and again when you get back in. Get either one wrong, and you'd have been better off doing nothing. Now let's talk about dollar cost averaging, DCA for short. The idea is almost embarrassingly simple. You invest the same fixed amount of money on a regular schedule no matter what the market is doing. $10 a day, $100 a week, whatever fits your life. Prices up, you buy. Prices down, you buy. You remove the prediction game entirely. And here's the quiet magic of it. When the price drops, your fixed amount automatically buys more shares. You're loading up exactly when things are cheap. When the price rises, your fixed amount buys fewer shares. You are naturally easing off as things get expensive, without forecasting anything, without any crystal ball. The math itself makes you buy more at the lows and less at the highs. That's exactly what buy low looks like in real life, not as a heroic prediction, but as a boring, automatic habit. There's a second benefit that I'd argue matters even more. It removes your emotions from the equation. Fear and greed are two forces that wreck more portfolios than any recession ever has. Timing the market feeds both of them. Greed at the top, panic at the bottom. Dollar cost averaging strays them. There's no decision to agonize over because the decision was already made. You buy on schedule. When the market crashes and everyone's panicking, you do not have to be brave. You just have to follow the plan you already set. The system does the hard part for you. Now, let me be honest about the fine print, because there is some. If you have a big lump sum of cash sitting ready to invest, say an inheritance or a bonus, the research actually shows that investing it all at once beats slowly averaging in. And most of the time, why? Because markets go up more often than they go down. So on average, money invested earlier does better. So if you ever see someone say lump sum beats DCA, that's what they mean. And they're not wrong. But here's the thing. The debate is almost irrelevant for regular people. Most of us don't have a giant pile of cash waiting. We have income, a little bit of money arriving every week or every month. And for investing money as you earn it, dollar cost averaging isn't just a good option, it's basically the only option. And it happens to be a great one. The real comparison for most people in DCA versus lump sum. It's DCA versus sitting on the sidelines waiting for the perfect moment that never feels like it arrives. All right, let me prove I actually practice this. Let's look at the real portfolio. I've been dollar cost averaging into Meta with small consistent buys since the channel started. No predictions, no waiting for the perfect bottom, just steady buys while it trades below its all-time high. Here's what that produced. My average cost sits around $627, and some of my buys came in as low as the 580s. I never had to call the bottom to get those cheap shares. The schedule bought them for me automatically on the red days when buying felt the worst. And now, with Meta trading around 668, the position is up about 6.5%. Not because I'm a genius, not because I timed anything, because I showed up on schedule and let the math do its job. Could I have done better if I dumped everything in at the exact bottom? Sure. And if I could reliably find exact bottoms, I'd be running a hedge fund from a yacht. In the real world, the boring schedule beat the impossible prediction. It almost always does. So here's the takeaway: timing the market requires being right twice, fighting your own emotions, and beating professionals at their own game. Dollar cost averaging requires exactly one thing: consistency. One of these is fantasy, the other is a habit anyone can build, starting with almost any amount of money. Quick reminder: nothing here is financial advice. I'm showing you what I do with my own money and why. Always do your own research. If you want to see this strategy play out in real time, every buy, the real numbers, the wins and the losses, subscribe and follow along. This is Highwater. Buy the dip, hold for the high.